Welcome to Dad's DeFi Space. Today we're going to be looking at how to turn your crypto and Bitcoin holdings into passive income. But before we begin, I wanted to start with a quote from one of my favorite investors, probably one of the greatest mutual fund managers, or the greatest mutual fund manager of all time, Peter Lynch, from Fidelity, who managed Fidelity's Magellan Fund. Peter Lynch says far more money has been lost to investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. Now, what this means is a lot of times we make too many changes to our portfolios, and this would be relevant whether we're stocks or cryptocurrencies. Peter Lynch knew that the more we make changes, the more we let our emotion dictate our decisions. And that's usually not where we make logical decisions. So that being said, let's get started and let's learn a little bit about liquidity mining. So before we get into liquidity mining, let's look at why we should invest in Bitcoin and cryptocurrencies to begin with. First off, it's decentralized. Obviously, Big Daddy BTC to the greatest extent. There's a potential for high returns, and Bitcoin can also act as a hedge against inflation. All of our interactions when we use cryptocurrencies are permissionless. We don't have to ask a bank. We don't have to ask our government. We don't have to ask our moms. Can I exchange? Can I give my value, give these coins to another person? Bitcoin and crypto allow global access to the financial system, which offers financial inclusion for many people who can't afford it, or it's just not offered to them in where they live. Now, why should we even consider using DeFi in the first place? Well, first, it's private and semi-anonymous, meaning I can make transactions, I can offer loans, I can basically be the bank, right? It's censorship resistant, meaning I cannot be censored for my beliefs. Like, what was it? PayPal a few years ago would withhold money out of people's accounts or take your access away from your account if they didn't like what your account or what you were involved with. I'm just not a person who believes that a government or an entity should be able to control the value that we create like that. DeFi also allows for direct peer-to-peer trading, and you can trade a variety of cryptos, a lot more than you can on a centralized exchange, high cap, mid cap, and low cap. And with the right hardware wallet, you can actually retain the keys of your crypto, and you don't have to worry about an exchange going down and you losing everything. Although there are risks in using DeFi, like smart contract risks, impermanent loss, hackers or thieves who might try to steal your money. Now, why should you provide liquidity to begin with? Well, obviously, first and foremost is cash flow. You want to make passive income on your crypto holdings that are just sitting there on your hardware wallet. There's a potential for high returns. You can earn fees, you can earn rewards when you provide liquidity. We'll get more into that in a minute. When you're providing liquidity, your assets stay liquid. What that means is when I'm providing, say, Bitcoin and USDC to a pool on Uniswap, I would be able to withdraw my tokens at any given time when I feel that I need to close the position, or I need to remove some funds because I have a bill to pay, or I want to move my money into another investment. Providing liquidity, since it's a form of DeFi, also offers a form of financial inclusion for people that don't have access to the banking system. And DeFi has a low level of economic entry. You can get started with dollars, a few dollars. When you provide crypto to a liquidity pool, you also support trading. And you don't have to be an accredited investor to be able to participate. So again, financial inclusion, it's good for everybody. So what is liquidity mining? Liquidity mining is when a crypto or cryptocurrency investor provides their assets to a DeFi protocol. They will earn rewards or trading fees. Yes, upwards of thousands of percent, hundreds of percent of APR, APY. When you provide liquidity, you are the bank. You completely take banks out of the equation altogether. Now, I thought this might help make some more sense, and what I wanted to do was give a little credit to the crypto exchange OKX. They had a great article on liquidity mining and what it is. I'll have a link in the description if you're interested in reading. But what I really wanted to show you all is this picture. This graphic really explains liquidity mining very well. First, you have the liquidity provider or the holder of the cryptocurrencies who provides their assets into the liquidity pool. The liquidity pool or the decentralized protocol provides LP tokens back to the liquidity provider. And then that liquidity pool is where a trader can go exchange assets. They would use a decentralized exchange to kind of facilitate that exchange of the assets, and the liquidity provider is the one who is providing the crypto tokens that are within that pool. So why would you provide liquidity in the first place? Is because the trader has to pay fees to the exchange, which in turn has to give those fees into the liquidity pool. And the providers of the assets in the liquidity pool will get a percentage based off what they provided into the pool of those trading fees. This is all represented in an LP token that's usually in the form of an NFT that would be within your wallet. This is a great way to earn passive income with your holdings if you're interested in not just letting them sit on your hardware wallet. Although I would never suggest putting more than a small portion of your portfolio into liquidity pools, because there are risks. You are using smart contracts that can be hacked, or you can suffer impermanent loss, and the value of what you provided can actually decrease, although it's not realized until the liquidity is withdrawn from the pool. Now, let's get a little bit into impermanent loss. I don't want to go into too much detail here, but impermanent loss happens within a liquidity pool as trades happen. Your assets are changed between the two. If the trader wanted to trade, let's say, USDC for Bitcoin, when they provide USDC into that pool, Bitcoin would go out of the pool. So the fees that you receive would be paid to in USDC, but the amount of Bitcoin you put in the pool would also change and would decrease. Impermanent loss is temporary in nature, but and the only way to really keep up with this is to document positions. I tend to do this one of two ways. Either I enter the position into an Excel spreadsheet, I use a protocol that manages it for me, or I take screenshots of my computer screen once I provide the liquidity, so I kind of know what I provided, what the fees were, and then what I withdraw at the end of the process. Basically what you need to do with impermanent loss is you want to compare it to what would have been your percentage of gain or loss if you just held the coins in your wallet. So what can we do about impermanent loss? What we can do is we can provide, there are mitigation strategies we can use to decrease the amount of impermanent loss. For example, don't ever provide liquidity in a pool that you don't have high conviction for both assets, because your tokens may be converted into the other asset. If you're not, you're gambling. Now, it's okay to gamble. I provide liquidity to meme coin pools occasionally, but when I do, it's usually a coin that I do want to hold, and I take profits when the coins run. Second, you want to make sure that there are high fees and rewards provided in the pool, or that are offered by the pool. That means that the pool itself has a large amount of a good amount of total value log, and that pool is being used a lot. So there's a lot of trading going on with the pool, which means there will be more fees or more rewards, which can offset your impermanent loss. The third thing is you have to make sure to monitor the price of all your pairs within the pool, because by monitoring the price, you will stay more on top of the permanent loss. And then select correlated pairs. And I don't want to get into all the details of correlated pairs, but you do want to make sure that your pairs follow, have a positive correlation during certain times of the market, a neutral correlation, or a negative correlation. But we're not going to get into all those details at this time. Now, this is not financial advice. I am not a financial advisor. I'm not a tax accountant. I'm just a guy on the internet. But I did want to offer you my personal strategy, or what I do with my LPs. Okay. First, I'm selecting assets that I believe in. Now, some of the assets that I believe in right now are ETH, Bitcoin, Arrow token, Sol, TIA, Injective, and Osmo. Now, those are just a few that I have high conviction in, that I'm willing to provide liquidity for. That is not an exhaustive list. Now, you need to make sure that you allocate to your risk tolerance. I'm a less conservative person. I play more aggressively. So I am willing to suffer a little bit more loss, or at least take a little bit more risk. Not suffer a little bit more loss, but take a little bit more risk for a little bit more gain. Now, your situation may be different than mine, and that might not be for you. Now, when you provide liquidity, you want to select a pool with at least $2,000 of liquidity. Now, you can go lower than that. I don't feel comfortable with my long-term and larger positions. I actually look for pools that are greater than 1 million of assets. And a lot of this is just, if you're in an illiquid pool, it can create issues when you need to make changes, whether you need to change your range, close a position, make a partial withdrawal, anything like that. Finally, any of my positions, as they grow and as my positions grow over time, I reinvest any of those profits into a couple different things. Either A, I just pull out the fees and add them to my hardware wallet, my bull run bag, or I sell it off into stable coins. And then with those stable coins, I can either provide loans and earn more yield on top of my liquidity pool yield, or I just have them in stables that I can use on a rainy day when the market bottoms out like it did the last few days. Now, again, these are my ideas. These are my strategies with my portfolio. You will have to figure out what works for you. Now, I wanted to take the next little bit to look at some actual examples of how you would provide liquidity in a liquidity pool. And we can use this not as something you should do yourself. Don't use these positions to create your own pools, because you may be watching this video a long time from now and things have changed. Also, I want to show you what a degen play would look like in a liquidity pool, just so you can see what it'll look like if the fees are moving. I would like to show you how to provide liquidity in a liquidity pool. For this, we're going to use Krystal ALM, which is a protocol on the Base network. It's a automatic kind of liquidity provider protocol, so you can search pools across different blockchains and find different percentage rates, the best percentage rates using their search function. The biggest issue with Krystal is not all the pools are available. I don't quite know. I have found that if I go to the actual protocols and search pools there, I find more options. But this app has a great interface. It's easy to look at, easy to use, and I wanted to use it for our example. This is our Explorer page where we can look at different pools along different chains. Right now, I'm actually in the base mainnet. I want you to pay attention and just look at some of these APR rates here. ETH and some new crazy meme coin called Crash. 1,600%. I mean, that's ridiculous. And if I go and like back up to the top and I'll look at some of the more blue chip pools, ETH USDC earn over 100% a year, or wrapped ETH and DAI 94% a year. I mean, you cannot find yields like this. You can even get very safe, stable yields off your stable coins at 20%, 18%, 12%. All of these rates 3x, 4x, 5x what can be offered by the traditional banking system. I mean, my high yield saving account earns 5% a year, actually a little less than 5% a year. That's small peas in the DeFi space. In fact, we're very, very, very spoiled with the percentage rates that are offered within this. So the power of compounding works very quickly if you follow the rules, or i.e., do not invest in things that you don't believe in, find correlated assets, and don't worry about the impermanent loss, but you do need to do strategies to mitigate that impermanent loss. Anyway, just a recap of the previous slide. What I would like to do now is show you how you can earn fees. So we're going to go into this crazy degenerate wrapped ETH crash pool. I don't even know what crash is. Please, this is not financial advice. Do not get into this pool. Don't copy what I'm doing. This is just an example. Okay, we're going to go to an extremely narrow range. Okay, a very narrow range. So we can earn some fees. And before we actually zap into the liquidity pool, I'm going to show you some of the parts of this interface. At the top, you'll have your trading pair, which is the liquidity pool. It'll show you the total value locked, the 24-hour volume, the fees, and the token address. I don't like to go into pools where the total value locked is lower than $20,000. And I like to make sure that my volume at least is double the total value locked. This will ensure that you do earn fees during the time period that you have provided liquidity. As you can see in this pool, it's over the 200K. The volume is pretty high right now, and the fees are pretty high right now. Now, if you look to the right, you'll see a price chart. This is probably when the coin was introduced. It skyrocketed up, and like most memes, so this one is probably not going to be looking too pretty. But we're going to zap in real quick at $100 and see if we can earn some quick fees. So what I'm doing right now is I click the Add Liquidity button, and then you will see a distribution of all the other assets within the pool. If I zoom out, you can kind of get a better picture. You can see that most people are providing the liquidity right around where it is at the present moment. Okay. Now, let's go ahead and zap into this pool. We're going to zap in 0.3 wrapped ETH right at around $100. Down here at the bottom, it will show you the price impact. And we are going to zap in. Now, once you have zapped into the liquidity pool, Krystal is going to manage the position for us, the range we set, and everything else. And I'll kind of show you what the position looks like once we zap in. It's been 10 minutes since we opened the position, and now we're going to close it. The total position is almost $110. The fees were approximately $1.60 that was deposited into my wallet. I am now going to zap the position out and convert everything to ETH, which there's not much to convert since most of the position was already converted. So I hope this tutorial helps you understand what a liquidity pool is, how to do a liquidity pool. Please like and subscribe. Until next time. Peace.